Well, my name is Brendan Kelly. I am an active property investor, author, property mentor, property market analyst, international speaker, and director of property predictions. John, who is also joining us, is a property investor, author, property mentor, property market analyst, international speaker, director, and CEO of Property Predictions. And it is our pleasure to be having you join us tonight. So one of the questions that came out, the first question, is directed more to John. John, you're online now. How are you?
I'm fine, thank you, and good evening, everybody.
I saw your webinar from last month where you did your State of the States report, and I've seen some of your presentations. Can you please expand on the three dynamics of housing market performance? Dave asked this earlier. Dave thought that they were people, places, and finance. Are those three an accurate description of the three dynamics, John?
Well, they sort of are. I'd use different words. I use the population, purchasing power, and properties as the three Ps. And the way in which they work is that we find that housing prices tend to boom when all three are working in the right way for investors. And that is, if you've got high population growth, people can get finance, and it's easy to pay off the loans. And of course, you've got a shortage of properties for sale. Now, if all of those align, then you'll get price booms. But sometimes they don't all align. And let's say, for instance, if you've got high population growth and purchasing power is low, but there's a shortage of properties for rent, then of course rents will go up instead. And the way they're playing out now is this latter. It seems to be the case in Sydney and Melbourne in particular. We've got some of the highest population growth for a generation, but the APRA regulations have turned the tap off or down, slightly in terms of purchasing power, but there's still a shortage of properties. And so what we're going to see over the next few years is rents rising in those cities.
Well, that's very exciting for those who have buy and hold properties. So if you're listening to this and you have some buy and hold properties, then I would be watching those three dynamics. They are, again, if you go back a slide, John, it is properties, population growth, and what is happening with APRA and with the banks. So if you keep your eye on the population growth in your particular state or capital city, or even in your suburb through Australian Bureau of Statistics as an example on population movements and quick stats, look at the purchasing power, meaning follow what will be happening with APRA and the banks, and look for changes in the stance on interest-only loans, or changes on the alignment between the percentage points of interest between interest-only loans and principal and interest loans, or an offering of LVRs that are higher than 80%, or relaxing on the valuations of properties and the ability to get higher LVRs. That will allow purchasing power to improve. Also, another thing to watch out would be then wages growth. If you're seeing, and if you've been watching the news recently, watching news articles, reading papers, you'll see a lot of stories around how wages have been relatively flat for quite some time. And there is a desire for people to earn more, having suffered no wage increase essentially for a few years now. And consequently, people are feeling it by way of cash flow, as expenses have, CPI has still been creeping up slowly, and as things cost more and wages don't climb, therefore money is squeezed as a discretionary spend. Once we see wages go up and a release on or an opening up of discretionary spend, we might see more purchasing power. And if we then have a look at the amount of properties that are on the market through realestate.com.au or Domain, we'll start to see then a pattern of what might be an opening of the door towards people looking to buy properties again. and for monitoring rents. Now, we had a question. That question was from Anne, I believe. And Anne is from Melbourne. Hi, John. How did you come up with your formulas? And can you share any of them with us? Well, that's very cheeky of her, but sure, let's see what we can do. And finally, or following up on that, was how does what you do differ from the DSR score I used to see in your investment property magazine? Tell me a little bit about the DSR score, John, for those who may not have seen it.
I will in a minute. I'll just answer the first part of the question about the formulas.
Please, fair call.
Okay. I had a slide specially prepared for that, and I'll show it to you now. This is, and why I don't want to answer this question about the DSR score
just yet.
This slide. And you're probably wondering what on earth this is, you know. I studied the housing market for over 15 years, and a number of studies have been done on how it performs. And one of those studies is the Herengracht study, which was done in Amsterdam. And the Herengracht is that what you see in front of you, it's a canal in inner Amsterdam. And this property analyst studied the house price change along all those houses you can see on either side of the canal for over 400 years. And what he wanted to see was, well, what happens to housing prices over long periods of time and what influences them? So it went through periods of wars, depression, you know, all sorts of different circumstances, but the houses themselves didn't change. They're the same houses. They've been there for well over 400 years. And what he discovered was that it's purely a case of supply and demand, that the house market, the prices in this canal fluctuated in strict accordance with supply and demand. And so he developed rules that you could use to analyze that, to measure changes in demand and supply. And that's what I then adapted to come up with the formulas that I use. And Brendan's going to take you through those and show you exactly how they work. But it looks at housing just like any other commodity and says it performs exactly the same way. And there's been a number of studies done, all of which, and I've done my own as well, which showed this close correlation between demand and supply. Now, the second part of the question was about the DSR score, and what the difference with that is, and what we do, is that we don't just look at the difference in supply and demand, we measure the trend over time, how it changes. And so what we can do is predict with a reasonable degree of accuracy what prices and rents are likely to do. The DSR score, here's an example of it here, looks at 8 different performance measures. Now these, you can see some of them like renters, it's the number of renters in a market, OSI, which is online, the listings, how many of those, DOM is days on market, vendor discounting, and so on. So look at all of those 8 stats and work out how well a market is performing. So it'll tell you the higher the score, the better the suburb is, but that's current performance only. It doesn't predict the future. And so it means that a suburb might be performing very well right now, but it could be trending the wrong way. And that's where our systems are rather different.
Subsequent question, another question. And this one is from Richard in Sydney. Richard asks, I saw you once at one of your events recently, and that's to me. Oh, thank you, Richard, appreciate that. And you talked about the listings to sales ratio, which is, I guess, well, the DSR is what is a demand supply ratio. So this is an invert of that, the listings to sales ratio. Can you please run through that for me again? I think I missed something. Yeah, okay, no, more than happy to. The listings to sales ratio was built by John. When did you build that, John? That would have been what, maybe 8 years, 10 years ago?
Yeah, about 8 years ago, we devised the actual ratios, worked out what they meant, as Brendan's explaining to you here with this slide.
And the ratio, the thing that is always, and with the greatest of respect, John, always impressed me about what you've been able to do is the fact that you created a correlation between 12 months worth of sales, which you can just get in almost Your Investment Property magazine, RP Data, you can just get 12 months worth of sales, and it's a reliable statistic. 12 months worth of sales and the number of properties on the market right now. And if those two numbers equal each other, then you have a neutral market. And that correlation was just astounding, and I think is the basis of what you've been able to then evolve with different relationships and different statistics and numbers over time. So what I'll do then is I'll go through the ratios and give you an idea of how it works, if that's all right. So we're talking about in a supply-demand relationship, as with any other commodity that John was talking about earlier. In housing or in the property market, supply is known as the number of sales, and oh no, I got that backwards. Supply is known as the number of listings, demand is known as the number of sales. So if you go to realestate.com.au and look out the what's up for sale right now and say houses or houses and townhouses, then there'll be a certain number of properties on the market today. And then if you go to the back of Your Investment Property magazine, which is it's the only property magazine remaining right now. If you go to the back end of Your Investment Property magazine, in the pages where all the statistics are held, the second last column for houses and units, if you look up houses, look up your state and look up your suburb, look at the second last column, you'll get the annual number of sales. And those two items themselves are sufficient enough for us to get an idea of what we call a ratio. It's the listings to sales ratio, as I like to refer it, where it is a supply to demand type ratio and allows us to then gauge what's happening. So a 1-to-1 ratio, let's say you've got 100 properties on the market right now and you've got 100 properties sold in the last 12 months. That's about a 1-to-1 ratio. And we would class that then as a neutral market. And in a neutral market, what you're going to see pretty much no price growth, nor are you likely to see any price decline. So it is a good market for you to be able to buy into. What it allows you to do is as a buyer, to take your time. You're not under any real pressure. There is enough stock on the market to satisfy demand of buyers. You can take your time to negotiate. It is a nice, stable market for us to be looking to buy a property in. But what we can then do is contrast different ratios and see what they mean. And how it works out is that if, for example, you've got a ratio where listings is 1 and sales is 2, meaning, let's say, for example, you've got the same suburbs, there are 100 properties in the market right now, and there are 200 properties sold in the last 12 months. Well, that's a ratio of 1 to 2. And that suddenly becomes a seller market. That's where you've got more people looking to buy than properties on the market for sale. And consequently, you're getting some pressure on price. Now that ratio varies, and the seller market covers the range of ratio from 1 to 2 all the way through to 1 to 10. So if you're at, say, a 1 to 9, meaning there are 100 properties on the market right now, and there were 900 properties sold in the last 12 months, then you've got a high demand environment or a low supply environment. And under those circumstances, then you get a lot of pressure on price. The consequence of that environment is that as a buyer, you don't get to negotiate. You're often paying more than asking price in order to secure a property. And it kind of makes it an inopportune moment, an unwise moment to consider actually buying into for the purpose of making money, for the purpose of buying well. As an emotional buyer, if you're looking to live in that pocket and that you just happen to be looking at this time, well, then maybe you would buy anyway. But from a property investor's perspective, we would strongly encourage you not to buy in seller markets where the ratio is 1 to 5 and above, let's say. 1 to 4 is probably a bit of a push as well, because of the competition and your inability to negotiate well. Of course, then you get to boom markets, and boom markets are where there are 11 or more times the annual sales as there are current listings. For example, if you have 100 properties on the market right now, it might mean you have 1,200 sales over the last 12 months. Now, while you might be thinking 1,200 sales out of a suburb, that's really uncommon. I did some research recently on Pakenham in Victoria, and this number of sales in Pakenham was 1,100 per year, approximately, at the time I was looking at it, which I found really quite astounding. But it's more a case of greater variability in listings than greater variability in the number of sales. If we look at the converse then of what we're talking about, where we get listings exceeding sales, for example, you might have 200 listings for every 100 sales in the last 12 months. If you've got twice the number of listings, twice the supply than you have annual sales, then we've got really 2 years supply. As a result of having 2 years supply, it's going to take a lot to suck that up and to become a neutral market again. Doesn't take a full 2 years to do so, but it does tend to take a little bit of time. Consequently, what you have is an environment where vendors are more desperate to sell. They're more keen to sell, so they'll be more willing to drop their price. In their ability then or to move their property on and drop their price, what you have as a buyer is a great capacity to negotiate. But there's a conflict in being able to negotiate well in this environment, and that is that when you buy it, prices are still likely to be in decline. So that you would need to buy it very well and negotiate very well to mitigate any risk of further decline in the price, on the premise that the ratio was improving from 2 to 1 into 1 to 1, 1 to 2 and up. So if you're able to forecast then through either monitoring the ratio and guessing, or through getting a report from Understand Property or from Property Predictions around what's likely to come in your suburb, we call that a buy, hold or sell report. If you're able to get those forecasts, that gives you a great confidence in being able to go, okay, I'm in a buyer's market now. I understand that prices are going down, but I've got a great capacity to negotiate. I'll negotiate hard on the premise that I know that the market is likely to improve in the not too distant future, which is really quite exciting. The worst case scenario, though, from a buyer's perspective, is to feel like I have a huge opportunity to negotiate because the ratio is 4 or more to 1, meaning I have, let's say, 400 properties on the market right now and 100 sold in the last 12 months. Under those circumstances, you're in an environment where you've got 4 years or more supply. If you have 4 or more years supply of stock on the market, you have a stressed environment. Vendors are rapidly dropping price and attempting very hard to move their properties, knowing that they've been held for a long time. You might even have, if you looked at days on market, you might see 700 days on market. And there are some suburbs with days on market around the 700 days mark. But we're in an environment where it's stressed. If we were to buy in an environment where it's stressed or consider doing so, we would be able to negotiate. But because there's 4 years supply or more in a stressed market, it will take a long time for that market to turn and to shift into a neutral market where there is a potential for price growth. So again, you'd want to negotiate so fantastically that you have mitigated any risk of further decline. And the odds of that are not so great. So out of this then, when do we choose to buy and when do we choose not to buy? Well, the idea would be buy when the markets are predominantly neutral or near neutral. A high grade buyer market, meaning 2 to 1, closer to 1 to 1, or a low grade seller market, meaning something along the lines of 1 to 1 to 1 to 2 type ratio. They would be the ideal times to be looking in. The dilemma we face though with the snapshot in time, which is the listings to sales ratio, is that it is just a snapshot in time. And you need to monitor it for a period of time to see trend, or our recommendation, get some information from someone who's an expert in being able to read this sort of data and go and get a buy, hold, sell report from Property Predictions. That gives you the greatest capacity to give you a 6, 12 plus month forecast into what's happening in that suburb to know that you're buying well. John, does that cover off most of it?
I think so. I think the importance, as you mentioned, is to look at the way the trend is changing. You know, the sales going up or the listings going up, which way is the market moving? And a buy, hold, sell report that we produce on Understand Property. If you go to the website, they will tell you what the current market is, and what it was a year ago, and also which way it's trending, what the prediction is likely to be.
Of course, we don't rely solely, John, on the listing to sales ratio. You've particularly done a significant amount of research in other relationships, such that we not only can read and forecast what the listing to sale ratio tells us, but by applying that in a correlation with other statistical data, we can actually create great certainty around the predictions. Yes.
That's right, and we look at a number of other indicators such as the state of the rental market and vendor confidence. So we use these indicators to make the predictions even more robust than what they were when we first started.
That's very exciting. Anyway, next question. This is from Peter, who comes from Adelaide. Thank you, Peter. Brendan, I've seen you around and you talk about your 33% rule for renovating. Yes, we do. I love that rule. Great rule. You can obviously use the reports to help find suburbs where there might be growth for when you do a reno. Correct. But I can't find any properties that work for the 33% rule you speak of. Help. and you make a valid point. When I speak about the 33% reno rule, so for those who may not be familiar with it, it's really quite interesting sort of a rule. Basically, it states that when you buy a property unrenovated, you need to sell a property for 33% more than you bought it for in order to walk away with a profit. And the amount of profit that you walk away with by intent is 10% of the buy price. You have to do that. You have 6 months to complete the project from settlement to settlement. So that's 3 months to do the reno, 6 weeks to sell it, and 6 weeks for settlement for your buyer. And you have a budget for your renovation being 10% of the buy price. So if I put that into cold hard numbers, let's say you buy something for $500,000. If you buy something for $500,000, then you've got a $50,000 reno budget. You have 3 months to do your reno, 6 weeks to sell it, 6 weeks to settle on it. So it's 6 months settlement to settlement. And if you're able to achieve that and sell that for $666,000 or 33% more, then you will be able to walk away with a profit from that deal to the tune of $50,000 or 10% of the buy price. Now, that is the model on which the 33% rule has been created, and it works. It has been proven time and time again. The dilemma is, if you go to realestate.com.au and look for properties that say are unrenovated, none of them will have the caption that says, "This satisfies the 33% rule, buy me now." Doesn't happen like that. Generally speaking, the differential between unrenovated and renovated prices in advertised markets is not 33%. It's somewhere around the 20 to 25% type mark. Your job is to find the disparity that exists within a suburb between unrenovated and renovated for the maximum amount that you can find, and then negotiate the difference. You need to make the profit in these sorts of add value projects. They're not advertised as such, and they're not easy to find. So there's a requirement on your part to tend to negotiate pretty hard. Now that speaks back to the ratio that I was talking about earlier. And interestingly enough, what I've noticed about the ratio, the higher the ratio, meaning 1 to 3, 1 to 5, 1 to 7, the higher the ratio, the more squeezed the margin is between unrenovated and renovated properties. Because the more desperate somebody is to get into the market, the less they care about the quality of home that they buy. Conversely, if you are looking for greater disparity, then you have greater capacity to negotiate, as we suggested, in the lower ratios, such as listings to sales, 2 to 1, 3 to 1, 4 to 1. So as an idea then, the ideal ratio that you'd want to be looking into to buy would be a high grade buyer market being 2 to 1, or somewhere around the 2 to 1 mark, where you'll find evidence of disparity between unrenovated and renovated properties, because the buyer, the emotional buyer, has the capacity for time and a more discerning decision around what they're willing to live in and what they want to walk into as their own home. And as an investor, you have time to negotiate. So buying unrenovated properties in a buyer's market, you can negotiate far greater than you can in a warmer market. If in an ideal world, then what we're looking for is a ratio where it starts out at 2 to 1, on the way up to 1 to 2, 1 to 3, 1 to 4, let's say, where you can negotiate great buy prices for unrenovated properties, and then take advantage of the warmth in the market to hold your price firm for when you sell and emotional buyers looking to buy in. So the short answer is, it is difficult to find 33% rule differentials, but that's because it's not designed to be easy. It's designed to be a rule that you work to for buy, add value, sell cosmetic renovations, where you actually need to create and push boundaries on the buy price and hold firm on your sell price. I hope that works. If there's any questions on that, please, again, don't hesitate to email me, brendank@propertypredictions.com.au. Or if any questions come from this recording or from the webinar that you're experiencing live now with us, type them into the chat window, or email me later on, brendank@propertypredictions.com.au. Cool. Next question, John.
Oh, it's one for me. Great.
Hey, lovely.
Who's this from, Brendan?
This one came from John in Brisbane.
John. Well, John, so I'll read out the question. It's for me. You say you're 92% accurate in market direction for your predictions, but how can that be? Nobody's that accurate. I'm an accountant, but I've never seen predictions that accurate.
No, you've got to love a skeptic.
I hope there are 3 types of accountants: those who can count and those who can't. So I hope John's one of the ones that can. I'm sure he is. But John, the answer to your question is firstly that we look at past predictions, the results of our past predictions, to work out how accurate we have been. So it's in the past, because nobody can say without any qualms we are going to be 90% accurate in future. We don't know, but we have every confidence that we will be. But that's the accuracy that we have obtained. And the key to this is that we're looking at market direction. When we look at these are the stats that we gather every year. We do this in September every year, and we compare the results of our predictions to what CoreLogic has published for those suburbs. And that's the accuracy rate you can see, and it's consistently, there's only one example there where it's not 90%, and that was the ACT for price movement, which was 89%. But the reason it can be so high is because what we're predicting is generally in markets like, say, Sydney in 2016, 17, where every suburb was going up in price and was booming, or Melbourne. And it becomes pretty easy then to be almost 100% right. The trick is when you get to a point where the market's about to change, or where the growth is about to start. And that's where our accuracy is really important, because we predicted the Hobart boom just before it started, and it was the database that enabled us to make that sort of confident prediction. So it is highly accurate, but it's the direction of price movement and the direction of rent movement in which it's accurate. It's not the actual percentage change in price, because I don't think anyone can say this suburb's going to go up 35% or 40 or 50 or whatever. You know, that's beyond our capacity to predict, but we can predict whether it's likely to be a boom or go the other way. Here's another question
one for you,
me then. Yes.
This one comes from Zhang in Melbourne.
Great. Thank you, Tim, for your question. You know your reports, how far do they predict? I got one once and saw they were mostly 6 to 12 months. Can you predict further than that? Well, the answer to that is, and going back to those studies that were done on the property market, is when changes occurred, they could be predicted out to about 6 to 12 months in fairly, you know, the markets that Brendan talked about as being seller or boom markets. When you get to buyer markets and stress markets, yes, you can predict a lot further. Because when a market goes stressed, it's got, as Brendan said, about 4 years worth of stock. It can't change within, you know, a year or two. It's going to take a long time for all that stock to be taken up and sold. So we can predict longer, but we like to be sort of, you know, within the realms of confidence, say about 6 to 12 months. And it's still a benefit, even if you're a long-term buy and hold type predictor. There's nothing, or investor, there's nothing wrong with getting that, you know, immediate lift in price that occurs. If you're a renovator, then of course it's essential that you get that. So that's why we see this short-term prediction as being of the greatest benefit and use to property investors. Shall I go on to the next question, Brendan?
Yeah, let's do that.
Oh, it's one for you.
Oh, and it's huge. All right, let's go. Who was this from? This was from Jeff. Jeff from Melbourne. Brendan, I have two-bedroom apartments in Caulfield South. They're in small complex of 10 with large courtyard, nice, and Caulfield North with 2 courtyards and a complex of 8. Well, yeah, credit to him. The size of the complex is good. It's not, you know, it's not one of those 40-story 1,000 apartment jobs, which is wonderful. Both are renovated, good, but that means there's no add value component really within them anymore, and rent for $450 each, okay? And both have been appraised around $650, $700. So that's around about a 3% return, let's say. My question is, after holding both for over a decade, yep, with average growth, okay, or average growth for Caulfield North or average growth for Melbourne. Let's assume, no, it doesn't matter. Let's keep going. Should I sell and look at buying a small unit complex of 6 or so units in Ballarat or Bendigo? Give the complex a full reno upgrade and double the income, which I could retire on, or just hold tight and wait for capital growth in the Caulfield units. Any assistance with this big question will be much appreciated. Well, first up, I think as much as I love the question, and we might just take a moment or two to explore it, it really is quite complicated, and it's probably better held, better answered maybe face to face. Now, John, we've got an event coming up. Now, there it is, thank you. We've got an event coming up. Expert investing mentors reveal how to beat the banks and build your property portfolio in today's changing market. John, you're based in Melbourne. Those event dates are the 25th of August and the 26th of August. So if you, Caulfield North, I'm not sure if they're your rentals, not sure where you live. You're welcome to come to the Saturday event, and I'm more than happy to sit down with you for a period of time, and you and I can go through and analyze all of the questions you have around what you're up to right now, because they are some fairly big, massive life questions. Or Glenn Waverley, whichever suits you best. Can I get you to scroll back a slide, please, John? Yeah, thank you very much. Broadly speaking, and just as a high level for people who might be thinking about what should I do in a similar scenario, as a high level conversation without any real detail, the answer depends on how long are you willing to work. If you are looking to retire as soon as possible and get out of your job, then you need to make decisions centered on getting out of your job as soon as possible and retiring as comfortably as you can. If you're comfortable where you're at and what it is that you're currently doing, and you can tolerate it or even enjoy the work that you do and you're not in any rush, then it takes the pressure off for making such a decision. Of course, you need to then talk about the broader goals about, well, how much is enough to retire on? What is the lifestyle that you want to live? If you attempt to cut too soon into your capacity to create the wealth in an endeavor to get out of work really rapidly, you might cause yourself some discomfort in the longer term in your retirement years, unless you choose to take something on that's a little more active and aggressive for creating money through some other channel. Always possible. If you like your job and you're under no pressure, then maybe, and you're close to what you want, you believe in as a retirement income, then great, the decisions shift. So there are a couple of things that need to be considered, and some particularly being, well, how much do I want to retire and how much is enough? And at what speed do I want to get to that point? And those two questions play against each other as for the level of aggression that you need to go to in order to achieve that. So, Jeff, I invite you to consider those two questions prior to you and I getting together. Again, come to our one-day event, and you and I can sit down and go through it. Thanks very much again, John. Appreciate that. And we'll go through it. That's August the 25th, Saturday in Melbourne at the Westin in the city, or at Glen Waverley on Sunday the 26th at the Novotel on Springvale Road. So yeah, come along.
Now, Brendan, if anybody else is interested in going to these events, how can they register?
Yeah, great question. So for those looking to come to Sydney, we're actually in Sydney. We're flying up on Friday. We'll be there on Saturday and Sunday this weekend, and at Brisbane on the 1st of September. Come along. How to get on, go to resultsmentoring.com and click on the icon which says Beat the Banks, which is on the top right-hand side of the web page. Or to short circuit that, resultsmentoring.com/workshops. Come along and join us. They're pretty powerful events. The feedback we get from them all the time is just awesome. So if you've never been to one, yeah, great fun. Come along.
And
thanks, John.
Free, aren't they, Brendan?
Yep, no cost. They're a form of give back, a form of contribution, and an avenue for people to find out more about the Results Mentoring Program if they want to do it.
Terrific. And you provide food, wine, entertainment?
Lobster for lunch. And no, not at all. People do need to fend for themselves for food, but they are in locations where food is readily available. We make sure of that.
It's what you supply is brain
We make sure there are coffee shops around.
Excellent. Well, that's fantastic. Let's move on now to this question for Brendan. John. Now, we're running out of time, so we're going to have to move through this pretty quickly.
Okay.
In my discussion about this question, it was quite interesting because Brendan and I have got actually quite different investment strategies. So I'll explain mine first, and then Brendan can quickly explain his. But mine is about passive investing. That is, looking for those areas where there's going to be high growth in the market, good cash flow, and that's the strategy that I've used. The strategy I explained in my book, Unlocking the Property Market. When you start out, you haven't got a lot of money, so you've got low equity. You need to leverage. That means borrow as much as you can and buy in areas that have got high imminent growth potential. And you keep doing that using your debt to build equity, because the amount you're getting in the price growth is far more than the amount you're paying the bank, in interest. So that's the way you build your portfolio, and that's what I've done. And then at some stage, usually around, say, 40, 50 years of age, you start to consolidate. And then you buy properties that have got a higher cash flow, and you start to reduce your debt until finally, when you're at retirement age, you've got no debt left at all, and all those properties you own are providing you with the high cash flow and, the income you want in retirement. So that's my strategy. It's what I call passive investment. But Brendan has a different strategy, which is active investing.
Yeah, so my approach is more manufactured growth, manufactured profit. So it is buy a property, do something to it, sell it, repeat, take the money, go again. So we started out with renovations and cosmetic renovations, and then moved in and did a couple of those. I did DIY stuff, so I could pull apart a house and put it back together, which I did, which was great. I enjoyed it immensely, but I don't recommend DIY as a way of making money. And then it is getting into bigger deals. So it is you increase your skill, you then increase the size of the deal you can take on relative to your skill development and to your financial capacity, given that you've made some profit along the way. And then you continue to grow by doing multiple simultaneously. So it's start small, build skill, from skill, build size, from size, build multiples. And through that, then you are able to manufacture wealth, manufacture profit far more dramatically. So it is a process of, I guess, an exponential growth to achieve the financial outcome you're after. And so when you ask what have I held on to, there's nothing I've really held on to. Has been a process of buy, add value, sell, repeat. And I enjoy it immensely. It is a load of fun creating and running a property business, because in essence, that's what it is. You are running a business that is actively associated with a stock item being property. So yeah, the model is very different and has a great capacity for success and for wealth creation. So different, but yeah, good. As to where to buy, again, I rely on the reports from the perspective of guidance as to where I need to go to so that property prices either grow or remain flat while I'm doing my add value projects, so that I'm not needing to concern myself with price decline for the product I'm putting back into the market. And it's a risk mitigating exercise. So I hope that helps. And I want to thank, it was Robert. I want to thank you, Robert, for asking that question. Great question.
Here's another
Next
one.
question, John.
Yes.
From Anita. Brendan, how often do you produce your reports? We produce them by intent. We produce them every couple of months. And when is the best time to buy one? Well, when the best time to buy one is actually on the day that we advertise that they've just been released. That's a good time to be buying one. It gives you most of the time in the market with that report available to you to use. That said, as long as the reports are on the website, the reports are valid and able for use. We don't leave them up there. They do have a shelf life that we respect by way of prediction accuracy. And the sooner you get it, the sooner you act on it, the more growth you're likely to enjoy. But they generally have about a 3-month shelf life, broadly speaking. So if you find, if someone hands you an old report that they printed off somewhere or got from a friend, and you look at that and you go, oh, wow, it looks like, I don't know, Bundaberg is going to grow. My encouragement would be don't actually go and invest in Bundaberg. Look at the date of the report, and if it's more than 3 months old, it's not wise to consider doing that, because time has moved, and so have the statistics related to the analysis that allowed us to predict Bundaberg's growth. So when is the best time to buy one? When it's announced that they're available, and as long as they're on the website. But they get replaced, so there's at least always something on the available for people to download when they choose. Another one for me. This is from Caroline. Hi, Brendan. What's better, negative gearing or positive gearing? and what's the difference anyway? Great question. Negative gearing, there's some complexity about it, but I'll see if I can keep it simple and high level. Negative gearing is where you buy a property, you put down, let's say, a 20% deposit. There's therefore a loan to the value of 80%, and you have to service that debt. And when you rent the property out, the costs for servicing the debt, the cost for rates, insurance, any repairs and maintenance, When the negative gearing is when the costs exceed the rental income that you're earning from holding the property. So some numbers just as a high level. Let's say, for example, you are having a $1 million home and you're earning per annum, let's say $20,000. So that's a 2% return. If interest rates are currently 4%, and then you've got rates, insurances, repairs and maintenance, and that adds up another 2%, you're at 6% worth of expenses. So what you've got is 6% of expenses and 2% of rent. Then you've got a 4% discrepancy. You've got a negative gearing component to the tune of about $40,000 a year. Well, that's going to hurt. But that's what negative gearing is. It is, I'm not making enough money to pay all of my expenses. And as a consequence of that, I'm making a financial loss year on year. Now, if you take that information to your accountant, they will then be able to, depending upon your income, help you claim that loss as an expense during the year, and you will be paying less tax. So the benefit of negative gearing is your ability to pay less tax under certain circumstances, and you need to talk to your accountant as to whether your circumstances work for that or not. Positively gearing is the other way around, where, say, for example, you might have 7% of your property or the value of your property coming in as rent and 6% as expenses. If you have that scenario, then what you have is a 1% discrepancy in favor of income. So if you have $1 million property, let's just say, and you're earning rent of $70,000 a year and expenses at $60,000 a year, then you'll have $10,000 a year of additional income. That income will be taxable and will be taxed at your marginal rate. Again, personal circumstance, and you need to talk to your accountant to get that verified, what is relevant for you. But that represents the difference. Negative gearing is when you're not making enough rent to cover costs, and positive gearing is when you are making more than enough money through rent to cover your costs. Some of the consequences broadly, generally speaking, there's a base philosophy that says positive gearing is harder to get than negative gearing, and positive gearing is going to happen in more cheaper environments, cheaper areas, because the people who live there are probably more likely to be transient, and they'll pay rent in order to do their time for the period of time they need to be there, which means that you might not get as much aggressive capital growth in your property through positive gearing as you may in negative gearing, let's say, where you've got people who want to live there and rents are cheaper. It's people just buy those places for the better places to live, and therefore growth often exceeds the discrepancy between what you have to pay through lost revenue. So there's a bit of a balance in that. Now, what we've discovered, John, in our own investing, is that positive gearing can actually have growth as well. You've seen examples of that.
Yeah, if there's something that happens that changes the nature of the market dramatically, examples I've given in the past to where they built the cotton gin in Hay, and rent yields went up to 13%, which is highly positively geared, and yet prices doubled within 7 months. So you can get both if the right set of circumstances occur, but they're very hard to find, as Brendan said. So we'll move on to the next question.
Great question, great idea.
Yep. Currently invested in a number of residential investment properties in the southeast Queensland area. With the recent tightening of lending criteria and the ongoing Royal Commission, how real is the risk of a prolonged, generally subdued market across residential property throughout Australia? And I think it's probably, a question that many people are asking, and thanks, Jacques, for bringing this one to us. It's really interesting because there's a lot of different opinions. There's a lot of concern about what's happening in the property market. And being an analyst, I sort of look at the whole picture, not just now, but over a long period of time, to see, well, what's actually happened. And this is a graph which shows you the best performing capital cities each year. So if you look at in 2002, it was Sydney, and the growth in 1 year was over 25%. And then it was Brisbane. Hobart in 1 year, believe it or not, had over 50% growth in 1 year. Then it was Adelaide in 2005, Perth in 2006. And every capital city in Australia has had a turn at being the leader. But when you look, there's a gap there. And that is from 2011 to 2014. There's nearly 4 years where no single capital city was the best performer. There was no overall growth in the market. And we tend to forget that. You know, it wasn't all that long ago, maybe 8 years and less, that for a number of years there was no growth in the market. Now, was anyone, you know, talking about a crash then? Or no, they weren't. Now people are concerned, oh, it's all over in Sydney, it's all over in Melbourne. But we've had this occur many, many times. And it could well be that we're in for a few years of very low capital growth. But even so, I don't believe that's going to be the case, because I've got other information in answer to this question, which is, if you were to buy 3 residential investment properties for their 2 to 3 year capital growth prospects right now, where in Australia would you focus your buying? So yes, of course, I'm looking now at the 10-year growth per city. This is what's happened in the last 10 years. In Melbourne and Sydney, you can see that prices are more than doubled. And Hobart, although they haven't doubled, they've gone up a lot in the last year. But the other 3 capital cities have hardly gone up at all. They certainly have gone up by less than 50%. Brisbane, Adelaide and Perth's only gone up 6% in the last 10 years. Now, historically, when Melbourne and Sydney have boomed, the other capital cities eventually do the same. Remember that the best performing cities, they all had a turn. So it's not a matter of if, it's a matter of when. And when we look at the price comparison, look at Adelaide compared to Sydney. At the moment, a median house, say in Adelaide, is 45% that of one in Sydney. So one Sydney house could get you 2 similar houses in Adelaide. In Perth, it's less than 50% as well. So one Sydney house sold could get you 2 of the same types of houses in Perth, and the same in Brisbane. So all of these 3 cities have failed to, go up in price in the way that Sydney and Melbourne have. But when I look at the data, the supply-demand data, the population growth information, what I'm seeing is that Brisbane is the one that is going to be next to boom. And I've written an in-depth article for a forthcoming issue of Your Investment Property magazine, in which I not only predict that Brisbane will be the next capital city to boom, but I'll show you which suburbs are most likely to be the leaders and when this is likely to occur. It probably won't be in the next 12 months, but shortly after that, I think you'll see Brisbane booming. So that's the answer to the question, Jacques, is that I would be buying in Brisbane, in the areas that I mentioned in the article, which are pretty much the lower priced areas. So that's good news as well. In closing is give you our special offer of a 25% discount to any of our off-the-shelf property prediction reports. We've just released the state reports, and to get 25% off, all you have to do is go to Understand Property and put in the discount code STATES when you go to the checkout and order your report. Very similar, very simple. Just go to the shop, put in the code word STATES, and you'll get 25% off any of our prediction reports. So that means they're only $146.25 instead of $195. Go to Understand Property to get your property prediction report. Yes, Brendan.
Oh, I was just going to say, I want to thank everybody for joining us. It has been an enjoyable conversation, John, and I want to thank people for submitting their questions to us prior to the webinar, so we had the latitude to be able to prepare, at least in our minds, some of the responses. And for the slide presentation, John, you've pulled together for explaining how to look at the market more effectively and how to analyze statistics. So I appreciate that greatly, John. Thank you very much for that.
And not to mention my prediction of the next capital city to boom. You heard it first here.
I want to thank you ever so much for joining us. John, I want to thank you ever so much for joining me on this this webinar. Until we meet again, invest wisely.
Thank you very much, everyone. Good night.